Hello, and get ready because today is day 93 of our 365 Days to Financial Freedom series, and man, this is an intense one. Today, we're literally ripping the lid off the market to expose the hidden gears that most people just never see until it's way, way too late. We're going deep into the leverage trap, so if you've ever wondered why your portfolio suddenly gets wiped out in the blink of an eye, you are in exactly the right place.
Welcome back to the Neuro Finance Masterclass. Now listen, we have to issue a really serious warning right out of the gate for this explainer. We're stepping into the derivatives market today, and honestly, the mechanics here are incredibly dangerous if you don't know exactly what you're doing. This isn't your standard, everyday investing environment. No, this is a highly engineered, totally ruthless arena where the unprepared are systematically hunted by institutional players. So pay very close attention, because what you're going to learn today will permanently change how you view market volatility.
Okay, let's dive into this. Here is our mechanical breakdown for today. We'll start with number 1, the leverage trap, then move to number 2, anatomy of a liquidation, number 3, mastering the funding rate, and finally, number 4, the architect's strategy. Understanding these 4 concepts is literally what separates the hunted from the hunters.
So, starting off with section 1, the leverage trap. Just to connect the dots, yesterday on day 92, we learned how to track the massive players, the whales, using on-chain data. Today, we're connecting that directly to why the market suddenly drops or spikes 10% in a single hour.
Have you ever watched the market hovering peacefully and then suddenly, inexplicably, it violently moves? Well, it's not a glitch, it's not random news. To understand those moves, you absolutely must look at futures trading. Essentially, leverage means you're borrowing funds from an exchange to open much larger positions than your own capital would actually allow. Say you use 10x leverage. A 10% move in your direction magically doubles your money. That sounds incredible, right? It's exactly why amateurs flock to futures, treating it like some get-rich-quick casino. But here is the terrifying flip side. A mere 10% move against you completely vaporizes your capital. It is just gone. This is a deeply unforgiving environment designed to punish greed.
Which brings us to section 2, anatomy of a liquidation.
Let's move to and see how this built. What actually happens when that leverage trade goes against you? We need to drill down into the terrifying reality of running out of margin. You see, exchanges aren't charities. They have built-in self-defense mechanisms to ensure they never lose their own money when your bet goes sour. When your capital vaporizes, that's called a liquidation. And it builds into something even more destructive, a liquidation cascade. Here's how it plays out. Step 1. Retail traders crowd into the market using heavy leverage. Step 2. The price hits a clustered liquidation zone. Step 3 is the real kicker. The exchange automatically market sells your position to protect its own capital. You have absolutely no say in this. But step 4? That's where the real manipulation happens. Whales can actually see where these heavy leverage clusters are hiding, so they intentionally drive the price into these zones to trigger forced selling, which then pushes the price lower, triggering more liquidations and creating this violent, cascading waterfall. The whales engineer this on purpose to feast on the liquidity of amateurs.
Moving right along to section 3, mastering the funding rate. This is the secret gear of the market machine.
Now, what's really interesting about this slide is how we spot that trap before it springs. In crypto, futures contracts, often called perpetual swaps, have no expiration date. Because they never expire, their price could theoretically drift completely away from the actual spot price of the asset. So to keep their price anchored to reality, the market uses this massive, real-time sentiment machine called the funding rate. It's basically a periodic fee exchanged directly between traders every few hours. When the funding rate is positive, it means the market is overwhelmingly bullish. Too many people are betting on the price to go up. So the longs actually have to pay a fee to the shorts just to keep their positions open. But when the funding rate is negative, the market is panicking. Everyone is betting on a crash, so the shorts have to pay the longs. This rate tells you exactly what the herd is doing at any given second. I really want you to visualize this. When that funding rate becomes extremely high and positive, it means the retail crowd is blindly longing the market with heavy, incredibly dangerous leverage. The market becomes overextended, like a stretched rubber band. Tension is just building and building. This is exactly when the risk-reward ratio completely breaks down. And it's at this precise moment, right when the rubber band is stretched to its absolute limit, that the institutions step in. They engineer a sudden, violent downward flush, releasing the tension, snapping the rubber band, and liquidating all those overleveraged longs in one fell swoop.
All right, section 4, the architect's strategy.
Because the real question here is, how do we actually use this contrarian sentiment data to survive and thrive?
And this brilliantly illustrates the difference in mindset. You have to stop reacting to the market and start reading its hidden architecture. The amateur, well, they treat the market like a casino. They trade entirely blindly, driven by FOMO or sheer panic, and inevitably, they just become exit liquidity for the larger players. But the architect, the master of Neuro Fitness, approaches things differently. They use the funding rate as a highly strategic contrarian sentiment indicator. The architect reads the market's hidden data, so when the amateur is wildly euphoric and paying massive fees to stay long, the architect recognizes that the rubber band is about to snap and prepares accordingly.
So the crucial point is this: your daily cognitive task. You must implement what we call the cognitive sentiment check. Step 1. Open a crypto futures data aggregator. Tools like CoinGlass or Vela Data are absolutely excellent for this. Step 2. Check the current funding rates for Bitcoin and the major altcoins. Ask yourself, are they deeply positive, negative, or perfectly neutral? Step 3. Compare that sentiment data directly with the current price action. And Step 4. This is the unbreakable rule, folks. Never, ever enter a trade blindly without knowing who is paying whom in the leverage arena.
It's time to stop being the prey in these liquidation hunts. You now know the mechanics. You know exactly how the trap is set, and you know how to read the funding rate to see it coming before it hits. So, I'm going to leave you with this final strategic challenge. Will you read the hidden sentiment to rule the cycle, or will you remain someone else's exit liquidity? The choice is entirely yours. We'll see you tomorrow.